Property investments, are they still worthwhile? What are the risks associated? And what are the changes to your current lifestyle? So we're going to get into those numbers in detail. I've got a case study here that we're actually going to study. Also, what happens if something goes wrong, and how does it compare to a managed fund? So that's what we're going to get into. So first of all, right off the bat, this is an example where somebody's investing in a $750,000 property investment. They have 150 grand remaining on their home, right? So right now, to minimize some of the impact to their family income, one of the things that we could do right off the bat is stretch their existing home loan. This client had 10 years remaining. So by stretching the home loan back out to 30 years for their main home, freed up about cash flow of $785 per month. Of course, this costs more interest in the long run, but what it does do is it makes it more likely that they'll hold this property investment long term, which is very important, as you will see shortly with some of these numbers. But what ends up happening in terms of actual cash flow, in terms of their lifestyle, this ends up costing them about $4,000 a month roughly, right? That's including their existing home, okay? Now, other costs associated with this property investment, of course, you've got maintenance, you've got insurance, and you've got rates. So adding all of that in, you end up, broadly speaking, anywhere from 14 grand to 22 grand that the family has to contribute to hold on to this property investment. Now, I say 14 grand to 22 grand because we can, in this example, we took 5 years interest only. That's important because over 5 years, salaries can go up, rents can go up, so it lightens the load a lot for the long term and puts them in a pretty good space. And that 5 years can also help create a buffer, which is pretty important as well to really think about what if something goes wrong, if there's gaps in between tenants. Of course, right off the bat, we can apply for an additional 30 to 50 grand revolving credit, and this scenario would be potentially safe. But what would be safer if the family are already in the habit of saving, and instead of redeploying those savings straight into reducing the loan balance, we allow them to do that, but inside a revolving credit facility, so they build up a much bigger war chest for when things turn sour, if they turn sour, and it just makes them that much more resilient, right? So revolving credit is key to that. Now, in terms of the gain, what do you get over the long run compared to a managed fund? If you were to invest about 14 grand, $14,000 to $22,000 roughly over 15 years, you would end up potentially with 400 to 500 grand in a managed fund. That's at an 8.1% return, and $400,000 to $500,000 inflation adjusted, right? So not a bad wicket, but as you can see, compared to this property investment, if you're using a after inflation growth rate of about, say, just over 3%, 3 to 4%, sorry, just under 4%, where you end up with is around 700 to 800,000 equity after 15 years. So, you potentially are in a better space. Of course, there is the risk that you have got interest rates to contend with over that long term, and you also have to deal with managing the property in terms of tenants, right? So those things have to be factored in, but the gain is still there when it comes to property investment. Over the long run, you can see that the load gets a little bit easier. The reason for that is because rents go up, and with this graph here, it does also take into account inflation on rates, insurance, maintenance. However, rents go up, rates, insurance, maintenance, all subject to inflation. However, the interest is calculated on the loan amount. That loan amount is not going up by inflation, if that makes any sense. So that load actually only gets lighter over the long term. That's why you can see this diminishing kind of burden on the cash flow over the long run, right? So yeah, it's still worthwhile, but few things to, of course, make sure you get in place to do this safely, and so that you have a really good chance to getting to the long term, which is the only time you really see the real fruits, right? Because short to medium term, sometimes things can get stagnant. So I think, again, key thing is get your cash flow right. Make sure you understand why you're building buffers and have the ability to build buffers, right? Don't blindly just pay off debt if you're getting into an investment property, and expect that the banks or lenders will recognise how quickly you paid off past debt, and that will make it easier for you to borrow in an emergency, because it does not do that. You need to look after yourself. Also, think about the actual after expense returns as well. Be realistic with the impact on your lifestyle, and that might mean that you have to extend existing loan terms, or be very realistic in terms of how much you should spend on the investment, right? Because this is an example of a $750,000 property with rent of around $600, $650 per week. So the return on this example is pretty decent for Auckland. Outside of Auckland, with this kind of return, it wouldn't be that impressive. So you just need to make sure, what are you happy to put in every year? And often when you're looking at these numbers, we don't often take into account maintenance, right? So $3,000 to $5,000 maintenance per year is pretty important with any older property. And of course, rates can go up, so you're going to be on the upper end of rates. And insurance as well, $2,000 to $3,000 a year is probably going to be giving you the more realistic picture. So yeah, hopefully that's been insightful for you. Hamish at monline.co.nz. Always get good financial advice from a good mortgage advisor like ourselves, so that you can go into property investment safely and make it a secure long-term adventure, so that you get to the fruits, which are worth it, I reckon.